What if the entire decade-long debate about Bitcoin, the endless, exhausting back and forth, has been fundamentally wrong?
Hmm.
What if Bitcoin's true purpose was never to buy a cup of coffee, or even, to just replace gold in some dusty vault?
Okay, I'm with you.
What if it was built to become the engine for a global savings revolution, one specifically designed to pay an 11% yield?
That is the truly intriguing question we're unpacking today. It really, it perfectly encapsulates this massive strategic pivot we've seen crystallize as we head into 2026.
It feels like a pivot, yeah.
For years, the conversation, I mean, both for people who loved it and people who hated it, was locked in this really reductive debate.
Digital gold versus failed payment system. That was it.
That was the whole conversation. Is it just digital gold, a store of value you hold forever? Or is it a failed payment system? Because, it's too slow, it's too clunky, the fees are all over the place.
And as we're moving into this new year, the sources we've pulled together, the market data, the financial filings, they all suggest the answer is, well, it's definitively neither of those things.
Not anymore.
Not at all. We're seeing this sophisticated third path emerge. And it's not some niche little tech experiment.
No.
This is a mechanism that is actively disrupting the bedrock of the global fixed income market. We are talking about the $11 trillion corporate bond market.
Precisely. And this shift, I think, it marks Bitcoin finally finding its, let's call it, its adult identity.
That's a good way to put it.
It's shedding those utopian, and let's be honest, often naive dreams of its infancy, the early fantasy, that e-cash vision of decentralized, fast spending.
The coffee dream.
The coffee dream, yeah. By all functional metrics, it's defunct. But from the ashes of that failure rises something far bigger, structurally sound, and just infinitely more scalable.
And that is digital credit.
That is digital credit. Bitcoin has successfully transitioned from being a volatile speculative currency into the ultimate pristine collateral in the global financial universe.
Okay, let's break this down for the person listening, because digital credit and pristine collateral, that sounds like, very complex, inaccessible financial jargon.
Right. It sounds intimidating.
But here's the disruptive part, the almost counterintuitive bit that we saw across all our sources. This new vehicle, it's specifically designed for ease of access, for broad reach. It doesn't require you to download a wallet, secure a private key, manage a seed phrase, or ever, and I mean ever, interact with a confusing, unforgiving blockchain itself.
It is the ultimate abstraction layer. It's what makes Bitcoin accessible to the other 95% of the world.
Exactly.
And we're focusing today specifically on how one company, Strategy Inc., which people might remember as MicroStrategy, has really led this revolution.
You with their STRC product.
Yes, with their product, the series of perpetual stretch preferred stock, known by the ticker STRC, they have, in essence, created a Bitcoin savings account that is accessible right there on your standard brokerage platform.
It's a really incredible feat of financial engineering when you look at it.
It is. They've taken an asset historically defined by its extreme volatility, its non-productivity, and they've transformed it into a stable, high-yield income stream.
And this is where it gets really interesting, because that structure, it solves the two most crippling problems Bitcoin ever faced.
Volatility and usability.
Exactly. And that sets our mission perfectly for this deep dive. Our job is to map that entire journey, to understand how the market pivoted from chasing that e-cash dream to disrupting corporate debt, and most importantly, how a product like STRC manages to deliver that stable, reliable 11% yield to anyone with a brokerage account.
And we've got a formidable stack of sources here to do it, the detailed market analyses, Strategy Inc.'s own SEC filings, even some behavioral psychology studies that map out this whole transition.
Welcome to the deep dive. I'm Satoshi.
And I'm Satoshi.
Okay, so before we plunge headlong into the mechanics of that 11% yield and the $11 trillion market it's targeting, just a quick word about why we do this.
Yeah.
We started this show with a simple idea, almost a provocative one. Is there space for really deep, rigorous research analysis that goes beyond the headlines, outside of the usual academic settings or, the think tank chatter in those smoky cafes?
And the response has just been amazing. It's so clear that you're all as fascinated by these deep dives as we are.
We're seeing a tremendous amount of engagement, and that's what fuels this. And to keep producing this content, and critically, to start creating high-quality videos to go with it, we need your support.
Our current goal is really focused. We're trying to unlock funding for the Mosaic AI video editor by hitting 1,000 subscribers across all the major platforms.
We really want to get that funding for Mosaic AI because with a tool like that, showing these complex trends, visualizing how they cross-pollinate, crypto collateral, corporate bonds, psychology, it would just become so much easier to grasp.
It would be a game changer for explaining this stuff.
It really would. So please, if you enjoy these discussions, subscribe on YouTube, YouTube Music, Spotify, Apple Podcasts, Fountain.fm, or any other Podcast 2.0 app wherever you listen. It helps us a ton.
And just a quick practical note, this subject is so foundational to, well, the future structure of finance that we've actually created a new YouTube course.
Oh, wow.
It's based on some of these deep dives, and it specifically covers the nuances of STRC as a key innovation. It goes into the financial plumbing with visuals to help.
We'll put a link to that course in the description. I highly recommend you check it out, especially for the visual context on these structures.
Yeah. Okay, let's start the main dive. The story of 2026, it really is the story of digital credit.
It is.
For years, the rallying cry for Bitcoin was simple. It's a decentralized, cheap, global payment network. It's going to bank the unbanked, replace Visa and MasterCard.
That was the dream.
But our sources are absolutely stark in their assessment. That specific eCash dream is dead. That's the necessary reality check. You have to acknowledge the failure of the eCash narrative to really appreciate the brilliance of the pivot to digital credit.
So the vision was paying for everything, from a coffee to a car with Satoshis with SATs.
Yeah, that it would become this ubiquitous global standard. The core question is why that dream just, well, evaporated. And the answer is really twofold.
Okay.
Bitcoin just doesn't scale to that level, and maybe even more importantly, it lacks the price stability you need for daily commerce.
Right. Give us the hard numbers on that. Let's do the reality check against the incumbents. How does Bitcoin's base layer actually stack up?
If we look at the daily economic volume, and this is key, this strips out all the internal transfers and wash trading to give you a true measure of value settled.
So real goods and services.
Exactly. Bitcoin's base layer settles only about $7.8 billion daily.
$7.8 billion, which sounds huge in a vacuum.
It does until you put it into context. You compare that to just one incumbent, like Visa. Visa processes an economic volume of roughly $39.7 billion.
Every single day.
Every single day. So Bitcoin is settling less than a fifth of the volume of just one major global payment network. The infrastructure just isn't there for that kind of consumer adoption.
And what about the big hope, the layer 2 solution, the Lightning Network? That was supposed to be the fix, right? The engine for cheap, instant microtransactions.
It was positioned as the savior, absolutely. But the numbers just show stagnation. It failed to launch into the consumer consciousness. Despite years of development, a lot of capital, a ton of media hype, the Lightning Network's public capacity just hovers consistently low. It's around $509 million, or about 5,358 BTC.
That's it.
That's it. And while it's technically fascinating for us researchers, it completely failed to achieve that viral, exponential growth that you see with successful consumer apps.
Like Venmo or WeChat Pay.
Exactly. Those apps exploded in their first 18 to 24 months. Lightning just never managed to successfully onboard the average, non-technical person.
So if Bitcoin didn't win the payment war, who did? Because somebody is winning. Digital payments on blockchains are booming.
Oh, that's the easiest answer of the day. Stablecoins won.
Decisively.
Decisively, users wanted the speed and low cost of the blockchain, but they absolutely demanded the stability of fiat currency.
Well, of course. Nobody wants their grocery bill to jump 5% between the checkout aisle and the parking lot.
Exactly. And the market reflects that choice. Stablecoins like Tether, USDT, and USDC, they settled over $18 trillion in 2024.
18 trillion.
That volume just completely dwarfs Bitcoin's economic activity. It proves the user preference, hands down. Blockchain speed plus fiat stability beats decentralized volatility every single time for day-to-day transactions.
Okay, so the payment stream is dead. But here's the massive narrative flip we found. The shift from failure to success. Your analysis suggests this failure was actually a necessary, almost an evolutionary step.
It was a purification in a way. The core consequence of failing to become a high-velocity, everyday cash system is that Bitcoin succeeded spectacularly in becoming pristine collateral.
Okay, explain that connection.
We can look at it through the lens of history, specifically Gresham's law.
Right.
The principle that bad money drives good money out of circulation.
Right. People hoard the good money and spend the bad money.
Exactly. And Bitcoin is structurally deflationary. People hoard it because they expect it to appreciate significantly over the long term.
And if you're hoarding it, you are by definition not spending it. That makes it a terrible currency.
It's terrible for spending, yes. But that same deflationary nature, that expectation of appreciation, makes it perfect for backing liabilities.
The ideal collateral.
The ideal collateral. Why would you spend the asset that is scarce and you believe is going up in value? You don't. You keep it, you hoard it, and if you need cash, you borrow against it.
And that realization is the birth of this whole digital credit market.
That's it. The whole idea is to use Bitcoin's capital appreciation profile to fund these high-yield savings products for everyone else.
So the pivot to collateral solves the economic utility problem. It moves Bitcoin from being an unstable currency to a productive asset. But for mass adoption, we have to look at the second, and I would argue even bigger barrier.
The custody crisis.
The custody crisis, this is it.
This is the core infrastructural problem that capped Bitcoin adoption at maybe, 5% of the global population. The engineers, the hardcore technologists, the ideologues.
The people who actually enjoy managing high-level personal security.
Right. For the other 95%, the entire user interface of Bitcoin, just the act of holding it, was its biggest failure.
The famous crypto mantra, not your keys, not your coins. It's powerful, it's ideologically pure, but it demands an absurd level of security hygiene.
It's just completely incompatible with average human psychology.
Yeah, the behavioral data on this is really incredible.
It's so illustrative. It shows the psychological wall we're up against. We have studies showing that 70% of people feel overwhelmed or stressed out by simple password management.
70%.
7 out of 10 people struggle with managing 5 or 6 strong, 12-character passwords for services where if they get hacked, maybe they lose a few $100s.
And on top of that, more than half of them reuse passwords anyway.
Exactly. 53% admit they reuse passwords across multiple sites, even though they know the risks.
So that is the damning point right there. If half the population can't handle a basic password, how can we possibly expect the whole world to manage an irreversible 24-word seed phrase?
A single point of failure.
A single point of failure where if you lose it, or you write it down wrong, or it gets stolen, your entire life savings just vanishes. Forever.
Yeah.
With no one to call.
The expectation of forced self-custody was a fundamental design bottleneck. It's what capped adoption to just the tech-savvy crowd. It meant that self-custody, while maybe pure for decentralization maximalists, was institutionally and psychologically flawed for almost everyone else.
And the entire history of technology shows that mass adoption only happens when you hide that complexity.
You have to abstract it away from the end user, systematically.
Okay, let's use the source's historical examples here to set up what you call the iPhone moment. How did other technologies get past this hurdle?
Well, take the early internet. In the early 90s, it was niche. You had to understand things like TCP/IP, use arcane command lines, FTP.
It was clunky.
It was clunky and totally inaccessible. Adoption only exploded when applications like Netscape, graphical email, simple search engines came along and effectively hid all that underlying complexity.
They didn't change the internet, they just changed how we accessed it. They abstracted the protocol.
Exactly. Or think about early mobile computing. PDAs, early smartphones. They were cumbersome. You needed a stylus. You had to manage files like a tiny desktop.
A nightmare.
The iPhone came along and won because it replaced all that with a simple gestural touch interface. It abstracted away the file management. It simplified everything. The user experience was the key that unlocked the tech.
So we have the underlying technology, the Bitcoin protocol, which is robust and secure. But it's missing that intuitive, non-threatening interface.
Yeah.
We need the Bitcoin iPhone moment.
We need the abstraction layer that lets the global saver benefit without the cryptographic burden. And that, precisely, is the role of Strategy Inc.'s STRC product. These digital credit products, they are Bitcoin's long-awaited user-friendly interface layer.
This is the iPhone moment.
This is it. They abstract away all that terrifying complexity and the overwhelming psychological burden of self-custody that we just talked about.
Okay, let's walk our learner-listener through the actual user experience here, because this is where the disruption really happens. What do you actually do?
You interact with a standard ticker symbol, STRC, which you buy in a standard brokerage account.
Fidelity, Schwab, whatever you already use.
Wherever you hold your investments, you buy it just like you would buy a share of Apple or a bond ETF. And critically, there are no seed phrases to lose.
Zero hardware wallets to update.
Absolutely no risk of fat finger errors where you send your money to the wrong address and it's gone forever.
And the regulatory element here is just massive. It's often underestimated, but it connects this new tech to the existing trusted financial system.
That is the absolute key to making this acceptable to a multi-billion-dollar pension fund, or a university endowment, or, yes, a retired grandmother in Ohio.
It lives in the world they already understand.
Exactly. The assets are held in traditional financial institutions, so they're protected by SIPC insurance against the broker failing. The instrument itself operates within the familiar, trusted framework of NASDAQ and the SEC.
Let's pause on SIPC insurance for a second, just for clarity. Can you quickly explain what it covers and, crucially, what it does not cover here?
That's a vital point. SIPC stands for the Securities Investor Protection Corporation. It gives you protection, usually up to $500,000, if your brokerage firm itself fails.
So it covers the custody.
Right. It ensures that if your broker goes bankrupt, your shares of STRC are returned to you. However, and this is very important, it does not protect you against market risk.
Meaning if the price of Bitcoin or STRC goes down, that's on you.
That loss is your own, just as it would be if you owned Apple stock and its price dropped. SIPC guarantees the safe storage and access to your shares, not the price of the shares themselves.
Perfect, thank you. That clarifies the risk abstraction, which brings us to the financial utility. A Bitcoin just sits there, doesn't do anything.
It's idle. It generates zero cash flow. STRC, on the other hand, is designed to be productive.
It's the maturation of the asset.
Completely. Strategy Inc. financialized their huge Bitcoin holdings into this preferred stock structure. And let's define that instrument. It's a Series A, perpetual stretch preferred stock.
Okay, what does that mean?
Perpetual means there's no maturity date. The company doesn't have to buy it back. Preferred means it holds priority over common shareholders, the MSTR stock for dividends and in a liquidation. It turns a speculative asset into a productive income-generating one.
And that simple genius abstraction means anyone can now tap into the power of the Bitcoin network without ever touching the blockchain.
They've swapped the burden of cryptography for the familiarity and compliance of a regulated stock, and the result is mass reach. This product is now instantly available to trillions of dollars of capital that were previously locked out.
The sheer genius of this whole pivot to digital credit is realizing the target market was never the $5 coffee market.
No.
It was always the multi-trillion-dollar global savings market. This is the real scale of the disruption.
When we talk about disruption, you really need to visualize the prize. Strategy Inc. is not competing with PayPal anymore. They are attacking the massive pool of capital parked in fixed income.
And the sources point specifically to the U.S. corporate bond market as the immediate target.
It's the perfect proxy for capital that's desperately seeking high, reliable yield.
So what is the actual size of this financial ocean? Give us a sense of scale.
It is staggering. It dwarfs the entire crypto market cap many times over. The U.S. corporate bond market, that's both investment grade and high-yield bonds, it reached an all-time high of $11 trillion in 2025.
11 trillion.
And to put that growth in context, in 1990, that same market was only about $1 trillion, so it has grown 11-fold in 35 years. And every single dollar in there is actively looking for the best risk-adjusted yield.
So you've got this gargantuan mountain of capital, $11 trillion, just sitting there in traditional corporate promises earning what, 4 to 6% yields?
And those are fully taxable as ordinary income.
Right. And STRC is walking into this very sophisticated, very conservative market with a massively superior offer.
Absolutely. The implication for Bitcoin buying pressure is just immense. If this product manages to capture just 1% of that market.
That feels conservative.
Very conservative given the value prop. But just 1% of $11 trillion is $110 billion of new, persistent, yield-seeking capital flowing directly into Bitcoin.
That's continuous buying pressure. It drives up the price of the collateral in a self-fulfilling cycle.
Exactly.
So let's talk about that superior value proposition. Specifically, the critical update from January 2026 on the STRC yield. This is the killer detail.
This is what's making bond fund managers lose sleep. As of January 1st, 2026, Strategy Inc., definitively increased the annualized dividend rate on STRC to 11%.
11%.
That double-digit yield immediately attacks the high-yield bond sector, but it does it with dramatically better terms.
It's not just the rate, is it? It's the structure of the payout and the tax efficiency that makes the real difference.
Precisely. We have to detail the structure. First, the frequency. Dividends are paid monthly. That aligns perfectly with how people live their lives. Rent, mortgage, bills.
Like a true income replacement product.
But the true devastating competitive advantage is the tax structure. Distributions from STRC are currently structured as return of capital, or ROC.
And that means the distribution is largely tax-deferred.
Largely tax-deferred until you eventually sell the stock, maybe years or even decades later.
Okay, we have to unpack ROC with a concrete example because this is the secret sauce. Let's compare two $10,000 investments for a high earner, say someone in a 35% tax bracket.
Perfect. Let's call her Jane. So Jane invests $10,000. Scenario A, a traditional corporate bond yielding 6%. At the end of the year, she gets $600 in interest.
Which is immediately taxed at 35%.
Right. She pays $210 in taxes, leaving her with a net yield of just $390 or 3.9%.
Okay, now scenario B.
Scenario B, STRC preferred stock. Jane buys STRC yielding 11%. She receives $1,100 in dividends. Because it's return of capital, that $1,100 is largely not immediately taxed.
What happens instead?
Instead, the cost basis of her stock is reduced by that amount. She pays zero tax in year one on that income.
So Jane gets to keep and compound the entire $1,100, while her bondholder friend only keeps $390.
Correct. That's why, when you run the math, that 11% tax-deferred yield is mathematically equivalent to a whopping 18 to 20% fully taxable yield from a traditional source. The tax efficiency alone is a game changer.
That is the structural arbitrage they're exploiting. But let me ask, is this ROC status guaranteed? What stops the tax treatment from changing?
That's a fair and necessary question. The ROC status is based on a specific accounting reality. A distribution is classified as ROC if the dividend exceeds the company's taxable earnings and profits for that period.
And because of how Strategy Inc. operates, their taxable earnings are often low compared to the dividends they're paying out.
Precisely. It's not a loophole. It's a function of their business model, which prioritizes using new capital to buy more Bitcoin rather than generating immediate taxable operating income.
It's the killer app. Zero technical knowledge, double-digit yield, and massive tax efficiency. Now let's address the inevitable skepticism. We are talking about Bitcoin, an asset famous for 80% drawdowns. How can Strategy Inc. promise an 11% yield when safe banks are paying barely 4%? We have to look under the hood.
This is where their sophisticated financial architecture really shines. They rely on two key interconnected mechanisms, capitalizing on their market premium and maintaining a massive cash cushion.
Okay, let's start with the first one, this volatility arbitrage.
Volatility arbitrage achieved through what they call accretive issuance.
So we know that Strategy Inc.'s common stock, MSTR, historically trades at a premium to its net asset value, its NAV. Why do investors pay more for MSTR than just buying a Bitcoin ETF?
They're paying for a bundle of services, the convenience, the managed leverage, the institutional access, and now, most importantly, this income stream from the STRC structure. You're paying for the management and the financial engineering.
That's fascinating, but let me push back a bit. Isn't this whole thing reliant on that premium always being there? What happens if the market cools off or a competitor comes along and the premium shrinks down to, say...
That is the single largest structural risk critics point to, and it's a valid one. If the premium vanishes, the accretion model fails. They can't do it anymore.
So what's the plan for that?
Well, they've mitigated it in two ways. First, the premium is kind of baked into the structure now. People are paying for the yield and the tax advantage, which is hard to replicate. But second, and this is crucial, this brings us to their other mechanism, the war chest.
Okay, the war chest. This addresses the other big fear, the crypto winter.
Exactly. The fear that if Bitcoin drops 50%, they'll be forced to sell their Bitcoin holdings to pay the dividend.
And they took very aggressive, very public steps to eliminate that risk. This comes directly from an SEC filing.
The Form 8K filed on December 22nd, 2025.
And what did that filing show?
It revealed that Strategy Inc. massively increased its USD reserve, its cash cushion, to an unprecedented $2.19 billion.
$2.19 billion. That is a gigantic cash buffer. What does that mean in practical terms for the STRC holder?
It means stability. Our analysis shows that at the current 11% payout, that cash reserve provides approximately 3 years of uninterrupted dividend coverage.
3 years.
Think about the psychological importance of that. Even if Bitcoin enters a severe, prolonged bear market, Strategy Inc. can keep paying that full 11% monthly until almost 2029 without being forced to sell a single Satoshi.
That is the ultimate decoupling. The yield is separated from the short-term volatility. But let me challenge that. 3 years is great, but what if the bear market lasts 5? What's the contingency then?
Well, that cash pile isn't static. The war chest is designed to be replenished through their continuous financing activities. The bet is that the long-term appreciation of Bitcoin will always provide financing opportunities before that 3-year clock runs out.
And the absolute worst-case scenario.
In a true black swan event where no financing is available and the reserve runs dry, the preferred stock structure dictates that the STRC dividend would be deferred, not canceled. It would accrue until the company is back on solid footing, and it still gets paid before any common stockholders see a dime.
So even in a crisis, the STRC holder has priority. It's truly leveraging Bitcoin's greatest strength, its scarcity, while insulating the investor from its greatest weakness, its volatility.
And what's fascinating is how that huge war chest is a self-fulfilling prophecy. By guaranteeing 3 years of income, it makes STRC more attractive to big institutional buyers, which in turn reinforces the premium on the common stock, which keeps the whole flywheel spinning.
So what does this all mean for the learner listening? We started with the question of Bitcoin's true purpose. And when you look at the data, the engineering, the tax advantages, we're witnessing the complete maturity of the network.
We are definitively past the teenage years of magic internet money.
And the failed attempts to buy coffee.
Yeah. Bitcoin has entered its adult phase as digital capital. The protocol provides the pristine collateral, and Strategy Inc. has built the bridge. They've built the email client for the Bitcoin protocol that hides all the complexity.
So the message for the global saver is simple, and it's hopeful. You no longer need to be a cryptographer or a security expert to save in Bitcoin.
You just need a standard brokerage account.
This is the industrialization of savings.
It is. And we can finally put the comparison to gold to rest. Gold just sits in a vault. It costs you money to store.
It generates zero yield.
Digital capital, packaged as STRC, actively works to generate an 11% tax-advantaged yield. It's not a replacement for gold. It's a massive upgrade in productivity.
And if we connect this to the bigger picture, you look at the $11 trillion U.S. corporate bond market and the estimated $290 trillion global savings market, all looking for a life raft.
The migration of traditional wealth into digital credit has likely only just begun.
Which raises a huge final question for the future. The line between a tech asset and a financial product is blurring right before our eyes. Is this architecture the future for all foundational commodities?
It's a fascinating thought. Will we see similar high-yield, tax-advantaged stocks that financialize strategic oil reserves or digital real estate portfolios?
Turning stagnant physical assets into globally accessible, income-generating instruments.
The architecture is now proven and standardized. We've moved from pure speculation to deep financial standardization, and that is the true gargantuan change we are witnessing. So, as we wrap up this very deep dive, we want to remind you that this analysis is all based on publicly available information, SEC filings, market reports, but the story is still unfolding. The consequences are just beginning to be felt.
And we invite you, our listener community, to share your own analysis and sources in the comments. Are we being too optimistic about that NAV premium holding up? Are we being too critical of the old eCash dream? We want to hear from you.
We are always looking for critical collaborators to review our content, so if you're a finance expert, a crypto native with a sharp eye for these preferred stock structures, please reach out. We believe collaboration is what creates the deepest and most reliable insights.
And as always, keep searching. Keep the quest on. I'm Satoshi.
And I'm Satoshi.